Friends, very good evening to all of you. I welcome you all for this CP meeting on issues in capital gains. In fact, this is the last CP meeting of this series. We have been troubling, disturbing, and trying to get in touch with our beloved speaker, CA G Suresh sir, for various things of coordinating or getting some better speaker, especially in industry perspective. So we thought it's a high time he comes and addresses our members. There has been a quite gap where he's not addressed our SIRC members for quite some time. So we thought it'll be fit that he's been kind of doing only a passive role, and he plays an active role today. And the topic, one of his favorites, I will say, is issues in capital gains, because he brings a lot of different perspective to things and enriches us. In fact, I remember on capital gains one issue where they used technology to find whether the capital gains was right or not. It was an agricultural land and that was claimed, and the department went on to find through the Google Maps to see whether anything was cultivated or not. So today, more than books, today there are other things also which depends on the capital gains. Gone those days where we used to kind of manage with this information or that information. Today you have to be very correct. And on the challenges front, yes, it is kind of getting the correct interpretation or taking an interpretation which will withstand and see that kind of tests its proper times and the assessee stands to gain in the end. So we have with us our beloved speaker CA G Suresh sir, and joining with us our treasurer of SIRC of ICAI. Let me call it the resourceful treasurer, as she's been always called, CA Geeta, who is joining from Bangalore, who will kind of address us. And today, capital gains, where it involves a lot of money, rightfully today she is one of the panelists for our session. Geeta ma'am, over to you, where you can share your thoughts, and then we introduce the speaker.
Okay. Thank you, sir. Happy evening to one and all virtually present here. It gives me an immense pleasure to be part of the team headed by our dynamic chairman, C.A. D.C. Jain sir, and secretary C.A. Abhishek Murli, who have been consistently hosting webinars of great significance. Today's session, in one such session which always presents us with new learning, since it's always a plethora of new rulings which gives us new perspective of the same law. And it's undoubtedly a well-known fact that the strength and potential for growth of an economy is determined by the ease of obtaining capital by new ventures. And it's significantly mentioned here that these investment decisions are widely based on capital gain taxation. And the capital gains is one such area which has maximum tax planning opportunities to save a huge amount of tax. However, the loopholes in the tax provisions were exploited to escape taxation. And over the years, these concerns were addressed with consequent provisions and sometimes with retrospective effect also. And we were also aware of this recent health Vodafone case, and it is based on the transfer of shares in non-Indian companies which derive a substantial value from underlying assets of Indian assets. So since the then existing law had a loophole which was driving away from the actual intent of the law, so the government later that year amended the Income Tax Act retrospectively, putting the liability back on Vodafone. And recently, again, this Vodafone has come into news, and this case was again when the tribunal ruled that the Indian Income Tax Department was in breach in terms of laid out in the Indian and Netherlands bilateral investment treaty. So there are such plethora of cases and issues that have a controversial element in them with respect to the provisions and intent of the legislation as well. So I'm sure that today's speaker, G Suresh sir, will give us a detailed insight on this field and equip us for better applicability and relevance of this provision in capital gains. So with this brief note, I wish all the viewers a happy learning session. Thank you.
Thank you so much, Geeta ji. Thank you for giving the perfect warm-up for this session. Abhishek, we can introduce the speaker formally, then we'll request him to address.
Thank you so much, Chairman, Dynamic Chairman of SIRC, C. Dungachan Jain, my dear participants who have joined in today, the very, very resourceful treasurer, as the chairman rightly put, C.A. Geeta ma'am, who gave a very lovely introduction. She is a person who's soft spoken, but her points are always hard hitting, and she has continued to do that today, where she gave a very, very nice opening. So, thank you so much for a lovely address, ma'am. And of course, our beloved speaker for the day, my guru, my teacher, SCA G Suresh. As you're all aware, capital gains is a evergreen topic, and our speaker today, usually whenever I organize a program, the first name is always TG Suresh. Then only we think who are the other speakers. And I used to remember when I used to attend SIRC classes when I was preparing for my CA final examinations. His capital gains classes was unmatched. So much that his name is TG Suresh, but we used to call it CG Suresh sir classes because capital gain classes like that. So now I have the privilege of formally introducing our speaker because he's a CA, he's a CMA and a company secretary and a graduate in commerce from Vivekananda College. He's a leading faculty in Chennai and across South India in domestic taxation, international taxation, financial management, cost accounting, and financial accounting for close to 3 decades. He has been a pioneer and a role model for more than thousands of students and pursuing CA, CMA, CA like me. I'm one of them. And he's a visiting faculty across all the councils of across ICAI and across the entire southern region as well. And he has been a regular faculty at RTI Chennai. And he, needless to say, is an excellent speaker, author, paper presenter, publishing of articles, etc. In fact, he has authored several books, including Simplified Approach to Direct Tax Laws, Simplified Approach to Taxation, Capital Gains Tax, Law and Practice, published by LexisNexis. And I must say, as someone who practices in the tribunal regularly, his book is our go-to book. Anything relating to capital gains, we search only for TG Suresh sir's book. And immediately once we use that, all our doubts are clarified. And 90% of the times we will win the case also. So he is a regular paper presenter and regularly has presented papers across not only India, internationally as well. His addresses in NASCOM, ICMAI, Madras Chamber of Commerce, Andhra Chamber of Commerce, Hindustan Chamber of Commerce. He is currently the chairman of the IFA, the International Fiscal Association, and he has organized excellent programs pertaining to international taxes, inviting some of the most reputed speakers globally as well during his term. And he is a coordinator of many of our programs, as chairman rightly said. And I must say, he is the winner of a national award from the Capital Foundation, the Society of New Minister. He is co-opted member of various committees of the SIRC and ICAI. And in fact, I must definitely make a point. I still remember 2 occasions where I had the opportunity to address with sir. The first was an address during Rani Sitai Hall, when the budget was announced a few years back. And coincidentally that day, the budget, even though it was announced, the speech went on for very long. And by the time the memo was released, it was almost 4 o'clock. Our program was scheduled to start at 4:45. And I still remember the entire time we were backstage, I was with Suresh sir, and he was going through each point, memo by memo, he was going through each point. He took a printout of the memos and he was reading. You will not believe it. In a matter of 45 minutes, the sort of threadbare analysis that he gave by each section was simply amazing. More than 2,000 people were present there and he received a standing ovation. That's the sort of speaker he is. He is a spellbinding speaker. In fact, even at SIRC last year, when he had addressed, the power went off. We had a power fluctuation. The ACs were not working during the hot summer in Chennai, and more than 250 members were there. Every single member was sweating. They were drenched in sweat, but they stayed till the end of his presentation. So he's a spellbinding speaker. He's a person who's very close to me and I enjoy listening to him. He's a mentor, he's a guide. And thank you so much, CATG Suresh sir, for accepting our invitation to be here today. We welcome you and we're looking forward to your address.
Thank you, Chairman. Thank you, Secretary. Thank you, Treasurer. So it's very nice to hear some great words from all of you. I want to point out here is that before the start of the program, you brought some youngster has come, clone printing lab, now you're asking, and then you nicely in a more than 30 years of experience. So I was thinking for a minute, then some 30-year-old man is addressing, but so So anyway, thank you. So thank you all, and once again, thanks the chairman and secretary and treasurer for inviting me for this program. Is all. In fact, whenever say I need to really thank me for organizing some program, I think it is a duty and responsibility here only because of the institute. Before the teachers, who will going to listen to me, right? So therefore, I think all whatever today is given by the institute, I think it is duty to give it back the opportunity. Therefore, happy that you have given me the opportunity. So thank you, and always well. The institute, whether for members or for the students, the privilege and honor to me. Feel free. So I'll be honored. So today, to remain as I really sensed my mind was, I think, the topic name was controversy. He's actually talking about issues. So possibly he thought since G Suresh is not generally doesn't like controversies. So I think at least he's avoided the word controversy now. So anyway, but I think the controversy is only the so Chennai, the topic is if I can also keep hot coffee with you and enjoy some very, very hot discussion for the next 2 hours or whatever time the institute allows, because as rightly put by the earlier speakers, when we start talking, we generally don't stop. That's a problem. Sometimes they have to stop me. 104 or 103. In fact, the days where I've taken the classes on Cambridge with such a high fear also, because this particular topic never gives that so much of energy. So therefore, you can take it at any kind of weather, any conditions, and so on. So what I just planned in this regard. So the are going to be totally, I selected 9, but I'm not sure whether I'll be in a position to run through. So basically, these are the 9 controversies which I'm going to deal with. Maybe like so when issued availability of under Section 54 beyond the due date for filing tax returns without deposit in the capital gains account scheme. So will you be eligible to claim the benefit? As an next for depositing in the capital gains account scheme. Situation of residential house and non-residential house been transferred. Can I choose exemption under both the sections with a single investment? So controversy surrounding that. So can I claim exemption to 54F even if I have more than one residential house? So the controversy number 5 will arise on the basis of I've been house which is less than 24 months, but my land is about 24 months. So what will be the nature of capital gains? It's going to be long term, short term, both. And if it is long term, will I get exemption under 54 or 54? An interesting controversy which itself may require around 2. Controversy number 6. So what is the meaning? 50 is attracted for the purpose of 54 or 54DC or 54F. For example, if my capital gains does not exceed 2 crores, I can invest in 2 residential house after the amendment of Section 54. But my capital, considered Section 50C crosses 2 crores, considered 50C stamp valuation, it is less than 2 crores. Now, will I get the benefit of 2 houses, or will I go by 50C? The impact of it with the wide-ranging case laws across the country, we'll try to arrive at some kind of a conclusion. So, on exemption for available only locked. So I want to remember this particular issue support any decision as a Abhishek and other factors. In fact, I can share this particular program was actually uh, the the chairman of the program was the chief commissioner of income tax. When I raised this particular point, almost when I was actually in the 20s, in fact, he pulled the mic that you want, you can appreciate, but department can never accept this. He is exemption under 54 EC for a short-term capital gains, which is unthinkable or unimaginable. But in fact, today the case has reached such a stage where today it has got a blessing of the Supreme Court. Therefore, we'll try to discuss the time about that. So the indexation when the capital gains, it's on account of cost of acquisition to 49.1, and if you're not able to complete the construction of the house, a position to claim exemption under 54 or 54F. So most try to give it at the exemption side, not because of anything else, because if you have the section to discuss, it will be a lot more easier. So that we don't too many sections to discuss, and so that we can go in depth rather than making a overview of it. We'll go in depth of each of the sections. That will serve the purpose much better than covering a different areas. So therefore, I just consciously decided to stick on to more on the exemption side. So the approach which I'm planning, so that all of us are really mentally prepared for how I'm going to go about. For each of the controversy, I have a case study. So then what I will do is I will the relevant provisions of this section first, though all of you will be aware of, but still, while discussing this, we'll go through the relevant provisions of the Act. Then we'll highlight the portions which is actually resulting in the controversy. Then what I will try to do is do some kind of a conclusion based on the possible discussion based. I will do some kind of a conclusion. So all of you have got entitled to have a different view. After all, what we have taken up is the controversy. Each one of us are definitely entitled to have our view. But at the end of the day, so I also stand to learn a lot out of this discussion. So as a result, Institute for giving me opportunity not only to share but also learn from this discussion during this wonderful evening where for the last 2 days we have some really ஒரு பொன்மாலை பொழுதாக இருக்க some nice and all in Chennai. So it's definitely a great moment to discuss about this topic. The controversy number 1. So what will happen to the exemption under section 54 and 54F without depositing in the capital gains account scheme? So this is a very interesting situation. So before I go to it, practical experience, I'll take some issues with the case which is slightly modified to the sessions. So by and large, this is something related to what has been gone through in the practical side of it. SEC sold an inherited land in Malaysia. That's the purpose of giving this case study so that we can understand the bit, because you also have some numbers. When you have practical situations before you, then it's always easier for you to appreciate rather than going through the provisions in total. So there is a sale of an inherited vacant land in Malaysia for a consideration of 100 lakhs. So the SEC offered the entire amount as capital gains. This is just for the sake of simplicity. We'll take the cost as zero, the entire capital gains offered. This is more from the simplicity of understanding the issue. So he purchased a vacant land on 10th June 2019, 10th January 2019 for 60 lakhs and started constructing the residential house in the above land. So he furnished his written off income 30th July 2019, claiming the entire capital gains exempt from tax under section 54. Though the construction of residential house is not completed on the due date for filing tax return. So on the date of filing, deposited under the capital gains scheme The construction was completed on 10th January 2020 with the total cost of construction amounted to 50 lakhs. So the for the land as well as the 20 lakhs of construction which was done up to due date for filing tax return. So being the amount spent up to the due date. So he refused to allow the amount spent in tax returns for the simple reason any amount of investment in section 54F after the due date for filing tax return should have come from the capital gains account scheme. That means before the date of filing of tax returns, the SSC should have deposited in the capital gains account scheme. So if you have not deposited in the capital gains account scheme, then you will not get the exemption even if you have invested the same, if you have invested the same within the time allowed for purchase or construction of a residential house. So this is the small point, but from the SSC's point of view, he was saying that he was not aware, neither he was aware nor his chartered accountant alerted him about the capital in the account scheme. According to him, he read the section, and from the section he can purchase within 2 years or 3 years. Therefore, he did that. That's what his viewpoint. So since we don't know what exactly the chartered accountant said, I don't think we should really give weightage to the SC himself. But the fact of the matter is that from his point of view, he was actually have to pay some tax based on the assessing officer's perspective of the same. So that's a small background. So find the case study so that we can appreciate the context of the discussion. So 54F subsection 1 talks about subject to the provisions of subsection 4. Subsection 4 is trying to deal with the capital gains account scheme. So where in the case of a necessity being an individual or a Hindu undivided family, the capital gains arises from the transfer of any long-term capital asset, not residential house. Hereafter in this section referred to as the original asset. The asset within a period of 1 year before or 2 years after the date on which the transfer took place, purchased, or 3 years after the date constructed one residential house in India. This amendment all be aware of was made from assessment year 2015-16. So hereafter in this section referred to as the new asset. Timing is not required. So therefore, the starting line of section 54F1 is subject to the provisions of subsection 4. Subsection 4 is nothing but the capital gains account scheme. Any capital other than residential, if invest in another residential house, you will get exemption under section 54F, to put the 54F in a very simple perspective. But the claim of exemption under section 54F is going to be subject to the provisions of subsection 4. But before we go to the subsection 4, which is actually the reason for this controversy, so we should also think in terms of 54F4 and also the proviso to 54F1. Now the proviso to 54F provided contained subsection shall apply where the assessee owns more than one residential house other than the new asset on the date of transfer of the original asset. Purchase residential house other than the new asset within a period of 1 year after the date of transfer of the original asset, or constructs any residential house other than new asset within a period of 3 years after the date of transfer of the original asset. Therefore, the process not own more than one residential house. You should not purchase more than one residential house, and you should not construct more than one residential house. But that is not the controversy of this section. The controversy is mainly surrounding on the now, as I said, the controversy to highlight. So we challenge associated with that, and then we'll try to resolve it. So this is subsection 4. Now, why the subsection 4 is relevant? This subsection 4 is relevant because subsection 1 starts with subject to 54F4. So what is this 54F4? The amount consideration which is not appropriated towards the purchase of asset 1 year before the date on which the transfer of the original asset took place, or which is not utilized for purchase of the new asset before the date of furnishing of return of income under section 139. So just look at the words which I've shown it in red. Before the date of furnishing of return of income 139 shall be deposited by him before furnishing such return deposit been made in any case not later than the due date applicable in the case of furnishing the return of income under 139(1). So therefore, if the case which I gave, the assessee purchased the then so he started constructing up to the due date of filing tax return, certain amount was spent in the construction, and thereafter, without depositing in the capital gains account scheme, he continued the construction. Only that, he also claimed the exemption at the time of filing of return of income on 30th July 2019 itself on the amount of investment which he has not made, which he is going to make in future. So whereas I think assessing officer be very fair to him, has rightly pointed out two things. The section starts with subject to 54F4. 54F4 says the amount of consideration which is not appropriated by the assessee towards the purchase of new asset made within 1 year before the date on which the transfer of the original asset took place, or which is not utilized being for purchase or construction of the new asset before the date of issuing of return of income under 139. So, whatever amount which you have not utilized for purchase or construction of the new asset before the date of furnishing of return of income, which in our case study is 30th July, be deposited by such return. So therefore, whatever amount you spent up to the date of filing of return, if that is not going to be sufficient for you to claim the full exemption under section 54F, so according to should have deposited the same, and only from the amount deposited you should have utilized for purchase or construction. So therefore, if you don't deposit the amount before filing tax return, even if the amount is used for the purpose of purchase or construction, is not going to be given to you. What the assessing of plain reading, I think to be very fair to him, the plain reading of the section very strongly supports his view. There's no doubt about the fact that the plain reading of the section. So it's very clear. Now, only thing is that this capital gains account scheme of 1988. So this capital gains account, you have a separate scheme also, capital gains account scheme of 1988. So you go to the memorandum which explains that provisions very clearly specified. So if this scheme is not introduced, the non-introduction of scheme like this results in rectification of the return. For example, SEC might come back and say proposed investment in the residential. He may not do the investment at all. If he does not do the investment, so what will happen? So you have to reopen the assessment, and once again, reject the claim of exemption or allow the claim to the extent of amount he has spent. There could be cases where the assessee says that he is going to make an investment and claims full exemption. He may not have invested at all, but if the department finds the same after 6 years, there could be a possibility of income escaping assessment, but still the department will not be in a position to include the same. Therefore, the memorandum very clearly explains the current provision of Income Tax Act, which does not specify the deposit scheme or alternative to that, because there is a time gap between your due date for filing tax returns and the amount available for investment. Suppose if I'm going to sell an asset today, I have a time till 29th of September 2023 to construct and 29th September 2022 to purchase. But I have to file the tax returns for the sale of asset which I made today by 31st of July 2021. But whereas the time limit for purchase or time limit for construction is going to be 2022 or 2023 as the case may be, depending upon whether you want to choose the option of purchase or construction. So therefore, there is an issue here where the SEC could say that I'm going to make an investment, I have that time limit, I will make the investment, I'll send the proof to you in due course, so give me the exemption. But if eventually it does not do it, one, the department sometimes within the 6 years radar, the income goes out of taxation and the department hands are tied, or even if the department is able to find out the, it needs a rectification of the assessment already done either under 147 or 154 or whatever process with the department feels comfortable about. So this is the background behind the account scheme from 1988. So again, the scheme itself, as the name itself suggests, you have to open it only in the public sector by not being a rural branch. There is a separate scheme in there, so let's not get into that part of it. And the return shall be the proof of such deposit, and whatever amount you all on purchase or construction, together with the amount deposited, shall be deemed to be the cost of the new asset. That is absolutely crystal clear. If amount already utilized for purchase or construction, in our example, 60 lakhs plus 40 lakhs, plus that if you want to claim, you should have only deposited the capital gains account scheme. From there, you have to spend the money for purchase or construction as the case may be. To that extent, as though it is a repetition, I think we must accept the fact on a plain reading of section 54F1 with F4, the assessing officer has definitely gone with the section. That's where the controversy is. So, on an identical issue, Karnataka took a very what is the proviso to section 54F puts an embargo on the application of section 54F to cases which are mentioned in the said proviso, that is, to be eligible for the benefit of section 54F1. The assessee should not be owning more than one residential house, or he should not purchase any residential house other than new asset within a period of 1 year after the date of transfer, or any residential house other than new asset within a period of 3 years after the date of transfer of the asset. So, therefore, in the entire, there is no prohibition for the assessee in putting up the construction of the consideration received by such transfer of a site which is owned by him, as is clear from the language used. It is open for the assessee to put a residential construction or purchase a residential. It is not the requirement or law that he should purchase a residential site and then put up construction. So the intention is not to retain cash, but to invest in construction or any purchase of the property, and if such investment is made within the period stipulated therein, then section 54F4 is not at all attracted, and therefore contention of the assessee that he has not deposited the amount bank account as stipulated and therefore is not entitled to the benefit, even though he has invested the money in construction, is also not correct. Therefore, in the entire gamut of section 54F4, why 54F4 is introduced. So whether 54F4 acts as an embargo for the purpose of 54F, with respects to the Karnataka Court, they were not considered those points. So what they specified here is that if the purpose is not to retain cash, so whatever consideration you received on your sale of existing asset, if you just start keep investing in your purchase or construction of residential house, that should be sufficient. The intent of the deposit scheme is only for those people who don't want to, the retaining the cash. Those circumstances, the section should apply. So if you are not retaining, as soon as the consideration, you start spending it on the construction, and they put a very interesting conclusion that you don't need to deposit. So maybe the Karnataka High Court would have also thought in this particular case, being an exemption provision, it actually deserves a more liberal construction. That one of the thought process in this particular decision. So, so long as you have used the amount for the purpose of purchase, I think let's give the benefit. So 54F4 and 54MC, the problem is the 54F1 is the one which gives the benefit. So 54F4 is only an enabling provision. So whereas the section which gives you the benefit is only 54F1. 54F4 is basically there only to aid the assessing who's going to have a challenge of time gap between the return filing to the available date for construction. So to enable that 54F4 is there. So therefore it is only an enabling provision, and I don't think so. Therefore, possibly the High Court would have thought. So the enabling provision cannot stand in the way of giving the benefit conferred by the main provision, and that too being a provision which is intended for promoting housing, which is intended as a beneficial provision, should be construed liberally. Again, recently the Madras Court has also followed the decision of the Karnataka High Court in Venkat. So therefore, at least this particular state, so we have some good thing in our support. So definitely, at least in the state of Tamil Nadu, so we have a jurisdictional High Court judgment. Even in this particular case, also the court considered this particular point, and they also mentioned this being a beneficial should be given a liberal view. They also talked about so all these aspects of it, and they came to a conclusion that the benefit under section 54 or 54F will be available even if the amount is not deposited in the capital gains account scheme. So there are some cases before the tribunal where the tribunal is willing to consider this proposition, willing to consider the proposition if the amount is kept by the SSC in a public sector bank, though it is not in the capital gains account scheme. The logic of some tribunals in this regard seems to be, though it will not be visible in the judgment, however, during the course of the hearing, the judges make the observation, so though you have not deposited the capital gains account scheme, so long as the amount of consideration remains in the public sector bank, they said fine. So this is actually a omission by the SSC that he is not aware that you have to go to the account scheme.
I think we have lost the audio. Suresh sir? Abhishek, you are trying to call TG Suresh sir?
Yeah, I am trying, Chairman. It's not going through. I'm just
Okay,
trying.
okay.
வணக்கம் கோவிட் 19
DG sir, it has got disconnected actually. He is just joining in 1 minute, Chairman. Some network.
Yeah, if he logs out and logs in, things should be fine.
Yeah. This quite heavy rate. So it is
Now
possible.
the bandwidth and the net connectivity always has a crunch on it.
To share with our members in the intervening period. On 1st of October, Chairman has specifically requested this, and we thought on his leadership, we are organizing a program. The MEF form is currently going on. I'm sure you're all aware. It is available for submission online, and a lot of doubts are there. So therefore, we have requested Central Council member CA Prasanna also to join us to address what these doubts are, what are the concerns of the members. So it is a free program on 1st of October. The details will be made available to you shortly. I think it's already been circulated.
Yes.
In case you have not received it, fine. It's a free. It's very easy to access. Also, a simple link. If you click, you'll be able to watch it. And any doubts that you have, we have circulated a Google form also. So you can fill your doubts in the Google form so that it will be taken during the session. Chairman, any words you want to share on the same?
Yeah, the forthcoming programs is on October, this 8, 9, 10, we are planning one program on technology. We'll be sharing you the details shortly. I request everybody to take part in large numbers. If sir has got connected, Abhishek, you can just check with him.
He said he was trying only.
Okay.
I'll call
And
him.
on 6th October, we are having a program on RERA by CA Vaitishwaran sir. So we request you also to take benefit of that. And there are lot many programs lined up. We will announce those shortly. And there's one program, 4-day refresher course on Ind AS is also being planned. Not Ind AS, sorry, it's on accounting standards. That's also on the in the pipeline. The first program just put it in box. You can store those links and save this, and on 1st October you can view the program. It will be available in SIRC of ICAI YouTube channel. They've also given a small link to add the event to your calendar so that even if you forget, before half an hour it will give you a reminder.
He is trying to join, Chairman. He'll be joining shortly.
Okay. And regarding our SCRC conference that's tentatively planned in the second week of December, we are just trying to get the dates with our ICAI president and other dignitaries. Once that get finalized, we'll be making the announcements on that also. So this year is a year of virtual events actually. And one more announcement is on this ICAI membership fees. 30th September was the last date to pay the fees. That has been extended to 30th November because of the difficulties faced by members. Suresh sir,
Sorry.
no issues, sir, no issues. Technology has its challenges too, where it
I
comes
think
with some advantages.
even the screen got excited with the capital instant. So, so anyhow.
Sir, thankfully we noticed. Otherwise, you would have been talking yourself.
Huh?
Thankfully we noticed. Otherwise, you'll be talking to yourself.
Hello.
Yes, sir. Yes, sir. Yes, Suresh sir. கொஞ்சம் விட்டு விட்டு கேக்குதுங்க சார். We'll switch off our video so that you get more bandwidth, sir. Suresh sir, you can also switch off your video to get more bandwidth, sir. Suresh sir, am I audible? Sir, am I audible?
இப்போ கேக்குது.
Sir, I will suggest you switch off the video to get more bandwidth, sir, actually.
Sorry,
You can switch off your video so that the bandwidth issue is not there, sir.
வீடியோ ஸ்விட்ச் ஆஃப் பண்ண சொல்றீங்களா?
ஆமா ஆமா, கொஞ்சம் bandwidth கூட கிடைக்கும் ஆடியோல.
Yeah, yeah.
Yes, sir. We were in this slide, sir. Exactly.
Hello.
Yes, sir. இப்போ கேக்குதுங்க sir. Yes, sir. Now you're audible, sir.
Sure. Okay. Thank you. So now, just in continuation of that, so criminals are taking a stand that since it is going to be a public account scheme has to be kept, even though you don't put in the capital gain. So if your savings bank account, if that is the public sector bank, will accept. So however, this is a very interesting observation, but at the end of the day, I don't think that is what Karnataka was trying to say. It is not talking about in which bank. In fact, it's talking about you don't even have to deposit, provided the intention is not to retain cash. But how the controversy is going to be duly there only when this view is not accepted by some other courts. I think the Bombay court has taken a stand. So the Bombay court is very clear. So 54F1, which grants exemption from capital gains where a flat is purchased either prior or 2 years after the date, or where residential is constructed within a period of 3 years, is now subject to the provisions of 54F4. It's very clear. The section starts with subject to 54F4. So thus, if your consideration is not appropriated before your filing date, then in those circumstances, the revenue wants to safeguard its interest So therefore, if you don't deposit the amount in the capital gains account scheme, then you are not entitled to exemption. So even though exemption is a beneficial provision, but beneficial provision of exemptions are given subject to certain conditions. And if you violate those conditions, then where is the question of reading the law beyond that? The intention of the legislature has to be read. The simple way of reading the section as it stands. Section says that you are eligible to claim exemption if you satisfy the conditions of. So 54 says if you don't purchase or construct before the date of furnishing of tax returns, option available to you is that you should deposit the capital gains account scheme by that time. If you don't do it, then in those circumstances, exemption should not be available to you. So therefore, right now we have the Madras High Court and Karnataka High Court are in favor of the SSC that even if you don't deposit, you'll be eligible to claim exemption. However, the Bombay High Court has said that 54F4 conditions must be satisfied because of the opening words of 54F1. So therefore, if you don't deposit before the date of filing of tax returns, you are not entitled to exemption. That is where we stand as far as this particular issue is concerned. With 2 high courts taking a stand, it's available, and 1 high court taking a stand, it is not available. So, I mean, the issue, the controversy will continue for some more time before, of course, the Supreme Court takes a stand. So that's where we stand as far as the issue. But one related issue here is a very interesting one. So if you read 54F4, the amount of net consideration which is not appropriated by the SSC towards a purchase of new asset made within 1 year before the date on which the transfer of the original asset took place, or which is not utilized by him for the purchase of 9 shall be deposited by him before furnishing such return. So such deposit being made in any case not later than 139.1. It's very interesting to the 4th line of the section. At the 4th line of the section, you will find the section talks about 139. Whereas if you go to the 7th line, the section talks about under subsection 1. So it's a very interesting point here. So when before the date of furnishing of return of income under section 139 shall be deposited by him before furnishing such return, such deposit being made in any case not later than the due date applicable in the case of SSC for furnishing the return of income under 139(1). So now an extended discussion. The first point we discussed about should the deposit is mandatory for you to claim exemption if you're investing after the filing of tax returns. That's the one point we discussed. The two court support the assist contention, whereas the Bombay Court is going by a very strict reading of the section, and therefore it's not available. An extended discussion of that in case if you have to deposit, should you have to deposit by 139(1) due date, or can you also deposit date? So in fact, it's about capital gains, Suresh. In fact, I just recall this is maybe my second program when I discussed about this particular point. So the president of ICAI, Mr. Priyan was also there when I was talking about this particular issue. But what I concluded on that day was slightly different. That's where he said, I think we can call him a CGS instead of TGS when this was it. But the things have changed dramatically today. But when this was discussed, my observation at that point of time, if you could not purchase or construct by your due date for returns, don't file your tax returns. Don't file your tax return. Hold your return, complete your construction or purchase, and then file your returns. then in that particular case, you don't have to deposit. The reason for my observation here was along the consideration which is not appropriated by the SSC towards the purchase of new asset made within 1 year before the date on which the transfer of the original asset took place, or which is not utilized by construction of new asset before the date of furnishing of return of income under 139. Therefore, my observation was, if you are not going to deposit, then still there is no need to deposit also. But only thing is that don't file the tax returns, because what the section, you should purchase or construct before the date of furnishing of return of income. So before the date of furnishing of return of income, if you have purchased and constructed, there is no need to deposit, because the requirement to deposit arises by virtue of the fourth line only if your net consideration is not appropriated, which is not appropriated before the date of furnishing of return of 139. There the subsection is not mentioned at all, whether it is 139.1 or 139.4. There seems to be no issue as far as this particular section is concerned. Trying to talk about the deposit. The deposit section talks about shall be deposited by him before furnishing such a return. Such deposit may be made in any case not later than the due date applicable in the case of SSC for furnishing the return of income under 139.1. Therefore, I was speaking at the point of time. If you want to purchase or construct, you have time till 139.4. But if you want to deposit, you have to deposit by 139.1 due date. So many senior members at that point of time were pointing out to me, saying that, oh, no, the fourth line and seventh line have to be read together. So that fourth line, you read it along with the seventh line, and therefore by harmonious construction, they were also suggesting to me that the fourth line should also be read as 139.1. So at that point of time, I very fondly remember, because I was young at the time, when a lot of senior members were pointing out, and I was just wondering how to respond. So Mr. Manoharan came back and responded. I agree with G Suresh, and I think that seems to be a very good point. I think this point we should call CGS for this point which he brought, not the things, but at that point of time. But however, now what has now happened is, so what we are discussing now, not about that issue now, can it deposit by 139.4? On a very plain reading of the section, so first of all, let me conclude, you can purchase construct without depositing up to 139.4. So because the fourth line does not have a subsection, only the seventh line has got a subsection. So now can I also deposit? What I'm going to discuss before you is not that issue, which seems to be pretty clear. Can I deposit by 139.4 due date? Assuming that I have not filed the tax returns, but when I filed the tax return, I could not complete the construction. Therefore, at the time of filing of return of income under section 139, so 139.4, can I deposit the balance of unutilized amount in the capital gains account scheme and claim exemption under section 54? So just to give clarity for this particular, I have not filed the tax return the due date. So I am filing the return of income under 139.4. At the time of income under 134, if I completely constructed, I have no problem at all. Fourth line itself is sufficient for me. Assuming at the time of filing of tax return, still I have some amount of capital gains still to be invested in the residential house. Can I file the tax return and deposit? All of us will be aware of today the due date for filing the belated return has come to the end of the assessment year. As again, that it was also 1 year has now become end of the relevant assessment year. So therefore, if I could not complete the construction by the month of March before the end of the assessment year, so I just want to still some more amount of capital gains left with me. can I deposit and claim exemption under section 54 or 54A? Again, on a very plain reading of the section, it appears that if you go by the deposit, you should deposit by 139.1. So the department also made a very strong contention. Court decision, the prosecution section, that the 139 means only 139.1, but that decision in Kanna was given in the context of a prosecution section, which obviously needs to be interpreted a little bit more strictly. But can we use the Supreme Court judgment given under 276E for the purposes of section 54F? The 2 points which the department was trying to contend here were 139.1 was mentioned, and 139 means, according to the Supreme Court, in the context of the prosecution provisions, only 139.1. But let's try taking a slightly different angle. Is 139.4 a dependent section or an independent section? Tomorrow, the government comes back and makes a very interesting proposal. Nobody need to file the tax returns. The return of income is not required to file anymore. Whoever wants to file, we ask them to file a serving notice under 142(1). Of filing of tax returns, dispense decision for the government. Now, so therefore, 139.1 removed. With that, 139.4 is automatically dead. So therefore, 139.4's existence is because there is a section called 139.1. There is a requirement for you to volunteer returns under 139.1, and therefore there is a section called 139.4 which allows you to file the tax return, the returns beyond the due date specified in 139.1. So therefore, if 139.1 is tomorrow omitted, but that 139.4 is automatically dead. So therefore, a return under 139.4 is nothing but a return under 139.1. If there is no 139, there is no 139.4. So what 139.4 is trying to do is extend the date given under 139.1, which could be 30th November or 31st of October or 31st of July, as the case may be, extends that date of 31st of July or 31st of October or 30th of November, as the case may be, to 31st of March. So it is not a section having an independent existence. It's a section which is a result of a section of voluntary filing of return of income under 139.1. So therefore, the due date of 139.1 gets an extension of 139.4. Therefore, a 4 should also be considered as subsection 1. So this was the SEC's contention. So therefore, I can even deposit before the filing of tax return under section 139.4. So therefore, the due date for deposit should be construed not only 139.1, should also be construed as 139.4. So this is the SEC's contention. Now, does it find some support? This is what the surprise part of it. So what I discussed at that point of time was, if you want to purchase or construct 139.4, if you want to deposit 1, but you have a long list of judgments which are given here, which support the view that you can deposit in the capital gains account scheme before 139.4 also. That means, so since 139.4 is an extended arm of 139.1, it exists in the law only on account of 139.1, and it's an extension of the due date specified in 139.1 is what 139.4. Though the Supreme Court decision on 139 means 139 given in the context of, so there the Supreme Court said that is the time, but it's the prosecution provisions are enforced in stricter cases on blatant violation of law. So therefore, those protections are right. But in a beneficial provision like section 54, so they said that that particular judgment has got no relevance. So in the context of 54 series, 139 means not even 139.1, it should also be taken as 139.4. Though section 54 or 54F4 specifically provide that deposit must be made before 139.1 due date. The benefit what we have in that section is the fourth line versus seventh line, which also comes to our support. So before the date of furnishing of under 139, but deposit is under 139.1. So therefore, as my interpretation was, this has to be 139.4, this has to be 139.1. But however, the courts are a little bit more kinder than me. They said both can be taken as 139.4. That means you can even deposit the capital gains deposit scheme before you file the tax return under section 139.4. So this is on the first and second issue on this particular point. So this is another interesting one. So I've sold a land. I've also sold a residential house, but I purchased only one residential house. So will I be entitled to exemption under both section 54 as well as 54F? So, so here I purchased one house, but I want to claim exemption under both 54 and 54F. The reason is if I purchase two houses in 54F, I won't get exemption at all. Maybe in 54 we can contend if you buy two houses, though your exemption is not going to be denied, but you will get exemption only for one of them. But in 54F, buying of two houses is going to result in you losing the exemption. You should not own more than one house. You should not construct more than one house. So therefore, this all put to a condition that it sometimes becomes difficult for you to buy two houses and claim exemption. So that is why I picked up one situation. What will happen in the case of one investment or one residential house, two sections, and I have also taken up two different years also. Just for the sake of this thing, we just put some case study number for us an easy appreciation of this point. A residential house sold for 100 lakhs on 1st October 2018, which results in a capital gains of 6 lakhs. A new residential house is purchased on 1/4/2019. For 100 lakhs and claim the entire capital gains is exempt from tax while furnishing is written off income for assessment year 1920. In the subsequent year, the vacant land was sold on 1st October 2019 for 100 lakhs, which resulted in a capital gains of 40 lakhs. So now whether I can use the 100 lakhs of investment which I made on 1/4/2019 for the purposes of 54F also. If yes, what is the amount which I should consider for the purpose of 54F as the amount invested? This is basically the point. So just to repeat, so I have 100 lakhs of sale of residential house on 1st October 2018, for which I have 2 years time limit to purchase. And I have sold a land on 1/4/2019, 1/10/2019, for which again I can purchase 1 year before, which is 1st October 2019, or 2 years after. So I have purchased on 1st April 2019. So the sale of residential house I have purchased within 2 years from the date of transfer. Therefore, that asset is eligible for exemption. And what is sold as a land on 1st of October, that is also eligible for exemption because I purchased 1 year before. But having already claimed exemption for this 100 lakhs in the last year for 54, can I use that amount as exemption for 54F also? If yes, what is the amount which I have to consider as amount invested for the purposes of 54F? Couple of interesting points here could be the first objection of the department obviously could be with one investment you are claiming two exemptions. Two, you have used the residential house sale of 100 lakhs on 1st of October 2018 for purchase of house, whereas your 100 lakhs of sale of land was not actually used. That means the capital gains on land was not actually used for the purpose of residential house. So what you have invested is only out of the sale of residential house. That means you are not investing the capital gains on the sale of land. What you have invested is only the capital gains of the residential house. Plus, you are buying one house and claiming two exemptions. If you buy a house, buy a bond, you can claim for house 54, bond 54 easy, not a problem because you are making two investments and you are claiming two exemptions. Here, you are making one investment and claiming two exemptions, and that is one. The second point also here is that the amount which you have invested here is only out of the residential house capital gains and not out of your vacant land. So these are the two principal contentions of the department. Now, first point is that we have already read 54F, and therefore we'll just quickly take our time to read 54 so that we are clear with the section. I will read one is 54.1 for the time being. Subject to the provisions of subsection 2, which is similar to that of subsection 4 of section 54F, where in the case of an assessee, being an individual or an HUF, the capital gains arises from the transfer of a long-term capital asset being buildings or lands appurtenant thereto and being a residential house, the income of which is chargeable tax and head income from house property. Hereafter in this section referred to as original asset, and the assessee is within a period of 1 year before or 2 years after the date on which the transfer took place purchased, or as within a period of 3 years after the constructed one residential house in India. So blah blah blah, what will happen in if you do that? So it's very clear from 54.1, two things is very clear. This section does not say, nor 54F, which you've already seen, both the section does not say if you claim 54, then you cannot claim 54F is not there at all. Both the sections only talk about subject to the provisions of the deposit scheme, which is subsection 2 under 54, which is subsection 4 under 54F. So you will not find either 54 or 54F specifically providing that if you claim exemption to 54, you are not entitled to claim exemption under 54F or vice versa. A lot of sections you would have seen, but if you claim exemption, you are not entitled to claim exemption under any other section. So that you will find. So as far as 54 is concerned, neither 54 nor 54 specify that. The second point as regards whether capital gains has to be invested. If you read 54, we've already read 54F also. Now, where in the case of an assessee being an individual or HUF, the capital gains arises from the transfer of a long-term capital asset being buildings or lands appurtenant thereto and being a residential house, the income of which is chargeable tax under IHP. Hereafter in this section referred to as the original asset, and the assessee is within a period of 1 year before or 2 years after the date.
Suresh sir,
On which, சொல்லுங்க அபிஷேக்.
okay, no, I lost you for a minute. That is why I was checking.
So took place or purchased or within a period of 3 years after that constructed one residential house. Therefore, you will not find anywhere in 54 stating that you should have invested from the net consideration or from the sale consideration or from the capital gains. What 54 or 54 talks about, there must be a transfer of a long-term capital asset being a residential house, whereas in the case of 54F, anything other than residential house, and the assessee has purchased within a period of 1 year before or 2 years. Therefore, you will not find anywhere in the section talking about out of such consideration you should have invested. So therefore, 54.1 and 54F1 are very clear. Transaction number 1, there should be a transfer of capital asset on account of a residential house. Any asset other than residential house in the case of 54F. And the assessee should have purchased or constructed another residential house in the case of 54 and 54F. The investment is same. Therefore, neither of the sections, as you can read any number of times, you will find requiring the consideration to be invested. So therefore, the contention that you should have invested out of the sale consideration of land is untenable because none of the sections require the same, the transaction independent. So we can trace many judgments starting from the Kerala High Court in KC Gopal, where the Kerala High Court specifically said there is no requirement to invest out of capital gains. Maybe we can take a very simple example also. Suppose let's assume there is an exchange. So I have a land Abhishek has got a land. Both of us decide. So I reside in Mylapore, he resides in Egmore. So he likes Mylapore, I like Egmore. So therefore, both of us decide to exchange the land. Luckily for both of us, the consideration, the market value is same, which is 1 crore for the sake of simplicity. There is no cash component is going to be passing on between me and Abhishek. But I have to capital gains tax on the base of 1 crore minus my cost of acquisition. So Abhishek has to pay tax on the base of market value of 1 crore minus his cost of acquisition subject to indexation. But both of us do not have a cost component. How will you then claim exemption under 54F or EC? There is no cash component, but the section does not say it's available only for sale. It talks about transfer, it's also exchange. So what I have made a sale, but my buyer has not given me the consideration. Where will I invest? So therefore, the law does not stipulate that you should only put that money for the purposes of claiming the benefit of exemption, which has been accepted in many cases, starting from the Kerala High Court in KC Gopal. So therefore, in this case which we have taken, exemption cannot be denied on account of two reasons. One is neither of sections specify that if you claim one section, the other section cannot be claimed. And neither of the sections specify you should invest out of your consideration. So therefore, you can easily accept or convince the department also that the exemption is going to be available under both the sections. But I don't think that is a controversy. I think all of us will be convinced that except for the investment out of the capital gains could be one of the challenges. But I don't think otherwise there is a big challenge. Fair amount of conviction will be there, though some of you may still disagree, but most of us will be in agreement. Now the issue now is the quantum of exemption. How much exemption is available? So let me take through the number. So first year, 1920. So there is a capital gains of 60 lakhs. The total investment is 100 lakhs. So therefore, I have claimed exemption of 60 lakhs. So total investment is 100 lakhs. Exemption available under section 54 is 60. Now the issue is how much amount is available for exemption under 54F in the next year. Is it 40 lakhs or 100 minus, which is 100 of investment minus 60 I already claimed, or the entire 100 lakhs? Because I purchased a house for 100. Should I have to take out the 60 which I've used for exemption to 54 and then take only the balance 40 for the purpose of 54F? Or can I continue to choose the same 100? So now next year, 100 lakhs index cost of acquisition. If I choose that method of using the balance, which is 40 lakhs, so all of us know that 54F is a proportionate exemption section. 40 lakhs is the balance of amount which is available for me after adjusting the 60 lakhs for 54 into the net capital gains by net consideration. So it is 24 lakhs. Taxable LTCG 36 lakhs. This is one easy view. I've taken 100, I've already taken 60 under 54. Let me take the balance 40 and compute 54F. Once you are convinced that you are entitled to claim both 54 and 54F. So total investment 100, exemption available under 5460, balance 6 lakhs, rather should be rated as balance of 40 lakhs is available for 54F. Therefore, exemption of 54F is 24 lakhs. Now, so before going to the alternative view, so I just would like to bring to your attention certain sections of income taxes. Some of them are still in existence, some of them are not in existence. CCCC, which is basically a pension scheme of insurance companies, where any amount paid or deposited by the assessee has been taken into account for the purpose of this section. A deduction with reference to such amount shall not be allowed under ATC for any assessment year beginning on or after 1/4/2006. So what does it mean? Today this section would have lost its relevance today, but for those who are familiar with ATCCC earlier, This 80CCC was available only up to 1 lakh. Now it is up to 1.5 lakhs. It was earlier available only up to 1 lakh. 80CCC is basically a pension policy. 80C is basically available for any life insurance policy. So if my pension policy also covers my life, I will become eligible for deduction both under 80CCC as well as 80C. Though the total of deductions under C plus CCC plus CCD cannot exceed by virtue of 80CC 1,50,000. So now what is this section was saying? Since 80CCC has also now become 1.5 lakhs, possibly you will find this discussion under the context of 80CCC as irrelevant. But just visualize for a moment, 80CCC continues as 1 lakh. If I had taken a pension policy for 1,50,000, under 80CCC I'll get 1 lakh. Will I get 80C? The answer is yes. But a deduction with a reference to such amount shall not be allowed under 80C for any assessment year beginning on or after 1/4/2006. That means what is 80CCC saying? If you have already taken a deduction under 80CCC with a reference to that amount which you have claimed under 80CCC will not qualify under 80C. This section is not saying both the sections are not allowed. What it says, you can claim 80CCC, and to the extent what you have claimed in 80CCC, that will not be allowed in 80C. So they are not saying 80CCC and 80C are not available. What is that only saying? To the extent of amount you have already claimed in the 80CCC, you are not eligible under 80C. That means they don't say 80C itself is not available. You can claim both the sections, but if you have claimed in 80CCC, you cannot claim under the other section. 35(2)AA. No deduction, the last claim where 35(2)AA is basically your weight deduction for a contribution to the National Laboratory or IIT. So last line alone is relevant for it. Then no deduction in respect of such sum shall be allowed under any provisions of this act. So therefore, you always find what you have claimed under 2AA does not qualify under any other provisions of this act. So now, if you take the discussion which I'm making 54 and 54, those sections do not specify that both the sections cannot be claimed simultaneously. Both the sections do not use the word, that what you claimed here will not be eligible for deduction under any other section. It's not there at all. So wherever you are eligible for multiple deduction, the section specifically mentions that you will not be eligible to the extent of such sum, or you will not be eligible at all, is there. 80CCC is a classic example. A deduction with reference to such amount shall not be allowed. That means you can also claim 80C also. If you take my example of if the old amount of 1 lakh had continued in 80CCC, if I put 1,50,000, I would have got 1 lakh under 80CCC. Balance 50,000 comes under 80C. But do you have a similar provision in section 54 or 54F? The answer is no. There is no prohibition to claim both the sections. There is no prohibition in the section to specify if you have claimed 54 with reference to that amount again will not be allowed under 54F. This also does not exist. With we already concluding that the capital gains need not have to be invested. What is required is there must be a transfer of capital asset other than residential house. Then you should have purchased a residential house. That should be done within 1 year before or 2 years after. If all those conditions are satisfied, nowhere the section says just because that was claimed under 54, again you cannot claim. Not there at all. And whatever you use for the purpose of 54, again you cannot claim for the purpose of 54. Not there at all. So therefore, an alternative view, which again the topic itself mentions, the controversy, would be instead of taking 40 lakhs as the amount for the purpose of 54, you can take the entire 100 lakhs been invested. So once the amount invested exceeds the net consideration, you are entitled to full exemption. So therefore, the alternative view is that with the support of many other sections, the cost of the residential house is 100 lakhs. No prohibition in section 54 to claim exemption to 54. Further section does not specify the amount exempt under 54 should be reduced for availing exemption to 54F. You can make a reference to 80C and 8060 on a comparative basis. As a result of it, for the purposes of 54F, instead of taking the balance amount as the amount available for 54F, you can take the entire amount for the purpose of 54F and claim the exemption as 60 lakhs. So this is the one very interesting controversy surrounding the eligibility of 54 and 54F simultaneously. And if yes, whether I should reduce whatever amount I've claimed for the purpose of that section for the purpose of this section. So I've just given what is the controversy, and I will leave it to your discretion in terms of how you want to approach the whole thing. So moving on in the same direction, can 54F be claimed if the assessee owns more than one residential house? And if one of them is a jointly owned house, whether you will lose the exemption. So let us just go back to 54F for a easy understanding of this section. So the 54F proviso specifies, provided nothing contained in this subsection shall apply where the assessee owns more than one residential house other than the new asset on the date of transfer of the original asset. So that means if on the date of transfer of the capital asset, which is eligible for exemption of 54F, if I own more than one residential house, then I will not be eligible for exemption under 54F. Having seen the background of this controversy, so let's just put a case study. It's a very interesting one. The case was picked up for scrutiny on account of multiple sale made of a different assets in the same year. So assessee owned a vacant land and two residential house two jointly with his wife. So vacant land was sold on 1st October 2019, house 1 on 1st November 2019, house 2 on 1st February 2020. SEC is clearly mentioned in the document on the return of income statement, all the dates. So it was blatantly obvious from on the plain reading of the return of income or plain go through the return of income. That SSC looks like is not eligible for exemption. So you have purchased house 3 for the purpose of exemption to 54F on the sale of vacant land on 1st March 2020. So the assessing officer straight away said that simple, you only give, see all these dates have not picked up from anywhere. Your memo very clearly says land was sold on 1st of October, your house 1 on 1st November, house 2 on 1st February. Therefore, on 1st of October, which is a sale of vacant land, you already have 2 houses. So therefore, there is a question of claiming exemption. But however, on speaking to the SSC, it appeared that he actually entered into agreement to sell the house 1 before 1st October 2019. There was an agreement to sell was entered. See, the SSC's buyer of house 1 mentioned that I need some housing loan, therefore you have an agreement to sell. So I'll use that agreement to sell to take a bank loan and then we'll register. Unfortunately, the SSC is not aware that the agreement to sell does not mean I've actually sold the property. You need a sale deal. A mere agreement to sell will not be construed as a sale. Therefore, he is under the impression, but having entered the agreement to sell the house 1 before 1st of October, he was having only 1 house as on 1st of October, and therefore he is eligible for exemption under 54F. That is one of the reasons why he wanted to claim the exemption. I think the SSC looked very, very fair in this particular point, and of course his understanding or belief, being a layman, also looks justified. So that's what the point I also mentioned here. It was noticed that agreement sale of house 1 was entered on 1st September 2019, but the sale date was registered on 1st of November. I also explained the background of this. The background of this was the SSC, the buyer of the property of house 1, he wanted a housing loan, and that housing loan got delayed. But meanwhile, his vacant land was sold, and the registration of the house one eventually took place after the sale of vacant land, which unfortunately resulted in assessee not getting the benefit of the exemption. So this is the point at which we have to take up this particular case. So therefore, as you would have seen from the plain reading of the case, it just looks like as if the assessee is definitely not entitled to exemption, because on the date of sale he has two houses, which is one of the requirement of proviso. It very clearly says nothing contained in 54F will apply if on the date of transfer the assessee owns more than one residential house. So now the two things which we can consider. There is a very interesting case by the Supreme Court in Sanjeev Lal versus CET, where though it is not in the context of the buyer, it is in the context of the seller, there was a agreement to sell. The property was sold almost after 1.5 years. So now the question was how to compute the short term or long term. Should we have to consider from the date of agreement or actual date of sale date when this property is eventually sold? So there was an agreement to sell. Subsequently, due to some reason or other, after 1.5 years, the property was sold after 1.5 years. But after the sale deed, that new house was transferred within the which resulted in short-term capital gains if you take from the date of registration of the document. But if you take from the agreement to sell, the asset become long-term. So the issue before the Supreme Court was, should from the point of view of the buyer, holding period should be taken from the date of agreement to sell or actual date of sale date. That means in our example, from the point of view of the buyer, should the short term or long term be calculated for house one from the buyer's point of view? Should that be calculated from 1st November or 1st September? Just to draw parallels to the decision. I'm not talking from the seller's point of view, but taking from the buyer's point of view, short term or long term, when he eventually sells the house, should it be from 1st September or 1st November? So what the Supreme Court said, they also quoting 247 clause 6 and all, they said that since this agreement to sell has eventually become a sale deed, so therefore the Supreme Court, considering 247 clause 6 and all, specified that you should take from the date of agreement to sell, because the agreement to sell fructified and the actual sale also took place. But the only thing in the particular case was the delay is also on account of some litigation. But though the facts are on account of litigation, but the judgment never said the reason for they taking a stand that should be from agreement to sell is because of the litigation was never there in the judgment. The Supreme Court was saying that there is an agreement to sell that was fructified. So therefore, there is a rights in the property was already intended to be transferred to the other person. Therefore, it will be a transfer within the meaning of 247 clause 6. And therefore, the long-term, short-term from the buyer's point of view should be taken from 1st September, not 1st of November. So I also put forward the same points here, that for the purposes of short-term or long-term from the buyer's point of view, if this transaction is going to be taken from 1st September, then from the point of view of the seller, you cannot say that transfer took place on 1st November. There cannot be a situation where buyer takes the holding period from 1st of September, but for seller, the transaction complete only on 1st November. If a buyer can take 1st September, the seller seems to have lost the asset as on 1st September or ceases to be the owner, rather in proper sense by 1st of September. So therefore, there was no two houses on the date. This was one contention raised. The second contention was, if you possibly recall, in section 32, the Supreme Court took a stand whether a fractional owner whether is eligible for depreciation or not. In that context, Supreme Court took a stand that unless you are a complete owner, unless you are a total owner, you are not eligible to claim depreciation. And this is one of the reasons why section 32 was amended specifically from 1/4/1998. 1/4/98, there was a specific amendment section, owned totally or partially. That means the partial ownership concept recognized in 32 to nullify the decision of the Supreme Court in 32. But we want to take the spirit of the section or spirit of the decision. The spirit of the decision means owner means you must be a complete owner. If you're a joint owner or co-owner, you will not be considered as that. So that is one point which has to be considered. So for having taken the stand, the Supreme Court has nullified that in the context of 32, but it has not nullified that in the context of any other section. So therefore, another point which was put forward before the argument was owner means you must be a complete owner. So in the case study which we have taken, in the second house was actually jointly held with his wife. Therefore, in those circumstances, you cannot come back and say that this is a owner of house 2 because he is a co-owner of the house, not a complete owner of the house. So since house 2, therefore, for the purpose of 54F, cannot be considered as owned by the SSC because ownership means you must be a 100% owner. If you are a co-owner of the property or a joint owner of the property, take also one slightly different dimension. If in this particular case, if the SSC is not able to explain his share of him as well as his wife, then the house 2 is going to be only assessed as a association of persons, a body of individuals. Whereas both 54 and 54F are available only for individual HUF, and therefore there is a requirement to own the property as an individual or HUF, not as an association of persons or body of individuals. So this joint ownership also helped in this particular case where 54F, even if the stand that house 1 sale was complete effectively on 1st of September is not considered, at least house 2 should not be considered as an owner for the purpose of 54F, considering the decision of the Supreme Court in 32 and also various points were also put forward. So the decisions to support this view is also there in the Madras High Court in P.K. Vasanthi Rangarajan, and also you have a Delhi High Court in Kapil Nakboy. So also you have Jennifer Bide in the Karnataka High Court. So these judgments also our argument in this regard. So the essential controversy is that so for the purposes of 54F, so should we have to consider from the point of the single ownership or whether co-ownership and joint ownership, will that be a blessing in disguise? Okay. So blessing as far as 54F is concerned. So that's the one other point which I just thought I can bring to your attention. So I'll move to controversy number 5. So sale of residential house with lands appertaining thereto, land held for more than 24 months and building sale for less than 24 months. So what will be the nature of the capital gains? Is it short term or long term? And the SSC purchases another residential house where the exemption can be claimed under 54 or 54F. So broadly, I own a land, but I've not done any construction. Then I started construction of a residential house at a later point of time. But after constructing the residential house, I sell the house along with the land. So the residential house along with the lands appertaining thereto was sold. Obviously, I sold a residential house through a single document along with the lands appertaining thereto. So basic from the point of view of the department here, if both are long term, so I would have taken this only as a sale of residential house, and I would have claimed exemption under 54. If my residential house becomes short term, a land becomes long term, according to him, the entire capital gain should be considered only as a short term capital gains. Because if it is both are long term, you only say that it's a sale of house and you claim only 54. So when your house is a short term, you should offer the entire capital gains as short term, and therefore you should not get the benefit of exemption at all because the capital gains has to be taken as short term. So whereas from the SSC's point of view, either the entire capital gains should be considered as a long term or as an alternative, land has to be considered as a long term. Maybe you can consider residential house as a short term. The worst come situation, but more aggressively, it should be considered as a long term. Maybe the assessee even go to the extent of saying, my building is a cost of improvement to the land, therefore the entire capital gains becomes long term. But from the point of view of the department, what you have sold is only the house, and you have sold the entire house, and therefore the sale of house, which is short term, because your construction is less than after the construction of the property, it's less than 24 months, and therefore the entire capital gains should be considered as a short term capital gains. But I think the first issue on the nature of capital gains, I don't think there is any controversy at all. Consistently, many courts have held the land does not cease to be a separate asset even after the superstructure is there. A famous decision of the Supreme Court in Hobbs Theatre. The assessee constructed a theatre and claimed depreciation on the entire cost, including the cost of the land. And then made an argument before the Supreme Court. But where is my land? After the construction of land, after the construction of superstructure, where is my land? So therefore, I should be given depreciation the entire amount. So furious with this argument, the judges made an observation: demolish your theatre, you will find the land. So the land as a separate asset continues to exist even after superstructure is built. The mere construction of the superstructure does not mean that your land as a separate asset ceases to exist. Therefore, you will get depreciation only on the building, not on the land. But the crux of the judgment is land as a separate asset continues to remain even after the superstructure. So therefore, in this particular case, the construction of residential house does not alter the character of the existence of the land. And since the land is held for more than 24 months, that becomes long term. And the house, since it is held for less than 24 months, it becomes a short term. Now, the next question is that whether the exemption will be available to 54 or 54F. But the department argument in this particular case, they also said we would have accepted the proposition of land long term, building short term or house short term, provided the assessee has entered into two separate agreements. But since you have entered into a single agreement for a composite consideration of 100 lakhs, we will try to hold the entire capital gains as short term. And they also said this 100 lakhs did not have a bifurcation for land and bifurcation for a building, and therefore the entire capital gains should be taken as a short term. Starting from the Madras High Court judgment in D.L. Ramachandra Rao, the Madras High Court suggested if that is your problem, there is no problem at all. The bifurcation of the consideration for the purpose of stamp duty, we will use it for the purposes of breaking up for the purpose of capital gains also. Land consideration and building consideration will be bifurcated using stamp valuation, but land does not lose a separate character. Therefore, land will be long term and building will be short term. So I don't think we have plenty of judgments. Subramaniam from Karnataka High Court, there are a lot of judgments. I don't think you will find any judgment. There is controversy on that particular point. But the controversy here is that there is a reinvestment. So the new residential house is purchased out of the sale process. Here my land is a long term, my building is a short term. So should I have to get exemption under section 54 or 54F? So whether the capital gains is short term or long term, well settled. We can even take it as a well settled, no more a controversy. Land will be long term, building will be short term. We all know that exemption under section 54 is available if there is a transfer of any capital asset other than residential house, if invest in residential house. So if you invest the capital gains on residential house and residential house, you will get 54. Anything other than residential house and residential house, you will get 54F. Now, since a house here is a short term and land is a long term, department's strong contention is that the exemption should be provided only under 54F. And once it is 54F, all of us know that you have to only put the net consideration. Whereas if it is 54, you have to only put the capital gains. Whereas if it is 54F, you have to put the net consideration. So as a result of this particular point, so therefore, once the exemption is shifted from 54 to 54F, there could be a potentially huge capital gains chargeable tax subject to interest and other consequences. So the controversy which I'm trying to bring here is that should the exemption in this particular case be provided under 54 or 54F? So again, since though we have already read the sections a lot of times, we'll again try to go to the section. So whether at all 54F is available. First point what we need to check is whether 54F is available. So subsection 1 of 54, if you read this particular section, before we read the section, if you take the case study which you have taken, what the SSC has done, the SSC has only sold a residential house. Only thing is that the superstructure was under 24 months. The land was held for more than 24 months. So that is the one context I want to bring it before we go to the reading of the section one more time. Now, subject to the provisions of subsection 4, where in the case of an SSC being an individual or HUF, the capital gains arising from the transfer of any long-term capital asset not being a residential house, not being a residential house. So it's very clear on the reading of the third line, you can come to the conclusion that I'm not eligible for exemption under 54F. Subject to the provisions of subsection 1, where in the case of an asset being an individual HUF, a capital gains arising from the transfer of any long-term capital asset not being a residential house. So therefore, if I transfer a residential house, which in my case, that is the case, I only transferred a residential house. So therefore, I am not eligible to claim exemption to 54F. I have not sold land separately and building separately as contemplated by the department, which they themselves would have given long term for land and short term. I have not done that. I only sold my residential house through a single document with a single consideration. So therefore, I am not eligible because what I have transferred is only a residential house. So will I get then 54? So if you go to section 54, that is a very interestingly worded section. Though colloquially we may say residential house and residential house, you will find on reading of section 54.1, where in the case of an SSC being an individual or HUF, the capital gains arises from the transfer of a long-term capital asset being buildings or lands appurtenant thereto and being a residential house, the income of which is chargeable tax in the high HP, and the SSC is within a period of 1 year before or 2 years after the date, or as within a period of 3 years after that constructed one residential house in India. At the time of transferred asset when they talk about, a lot of jargons are there. Investment, there's only one point. Constructed one residential house, simple. But look at the transferred asset. Must be a buildings or a land support thereto, and being a residential house, the income of which is chargeable tax on the high HP. So let us examine in our case whether these conditions are one by one satisfied. Transfer of capital asset being a building or lands appurtenant thereto. So now being buildings or lands appurtenant thereto and being a residential house. The residential house part of it are satisfied. Why I have transferred only residential house. This is one reason why I don't want to claim 54F. The income of which is chargeable tax in the high HP, that also would have been satisfied. Long-term capital asset being buildings or lands appurtenant thereto. As far as the buildings are concerned, it is not a long-term capital asset, but as far as the lands appurtenant to buildings, it is only a long-term capital asset. So therefore, for buildings, I will not claim exemption because of the fact it's not a long-term capital asset. For the lands appurtenant thereto, so therefore, house, that's satisfied. Income is taxed in the high HP is satisfied. Lands appurtenant thereto is satisfied. But the buildings part of it is not a I will be eligible for exemption under 4, not under 54F. So this is not a separate sale of land or building. It's a single sale of a house. The capital gains is bifurcated into short-term. It is not that I have two separate documents. One is land, one is building, one is long. No, it's a single sale of asset. The capital gains is bifurcated into short-term and long-term. all your discussion looks very interesting to listen. Can we implement? See, look at in the case of a joint developed, you are getting residential houses in your land. So you must understand you will be holding your land for a long period of time. The amount of flats which the builder has constructed, you might have sold immediately. This discussion helps you a lot because though the residential house is short term, the land on which you have constructed the residential house constructed given to you by the builder, that is long term. So if that is going to be eligible for you as exemption under 54, just imagine, because in 54, even if you buy two houses, the exemption still available at least for one. And if your capital gains does not exceed 2 crores, it's going to be even 2 houses also you can claim. But in 54F, if you have more than one house, or if you're going to buy more than one house, you're not eligible for exemption at all. That's the context. But this view which I've discussed has got the support from this decision of the Karnataka High Court, which has accepted this view, is that the exemption should be given only under 54 and not under 54F. So, C.N. Anantaram, which is Assistant Commissioner of Income Tax, joint development cases should be of a lot of help, because you get some 3-4 flats in your land and you sell that house immediately or within 2 years period of time. Though the house is a short term, because so the effect of that is that your reinvestment can happen under 54. 54's advantage is that it's sufficient alone. I think Anandaram case you test took at a different dimension. That's what's most important. DC, any the
Suresh sir, can we take one more? Can we take one more controversy and then go with question and answers?
Yeah. So, but this controversy will take. But yeah, while in fact, I consciously avoided this controversy first because the entire session would have gone in this. So I'll just keep this issue a little bit more simpler. Maybe I would have allowed this issue alone to be considered because a few programs on this topic alone went for almost 2.5 hours. So I just want to push this controversy to later so that I don't end up in discussing only one for the session. So this is a very, very interesting issue when 50C gets attracted. So whether full value of consideration determined under section 50C is to be considered for the purpose of 54 or 54F or the actual consideration. So basically, let's assume my cost is actual consideration, whereas my stamp valuation is 150. Therefore, should my capital gains be taken as 145? Now, what should be the capital gains for the purpose of reinvestment? Similarly, for 54F, the amount invested by net consideration. What is that net consideration? Should the net consideration be taken as a 50C point, or should that be taken on the basis of actual consideration alone? So this is a very interesting decision of the Bombay Court. Jagdish C. Dabalia versus ITO. Just a brief facts of the space is there is a sale considered of 25 lakhs and the entire amount of the bond is invested in 54EC. So in the return of income, assessee declared the long-term capital gains on transfer is 21.15. So obviously the difference between 25 and 21.15, which is 3.81 lakhs, should be the indexed cost of acquisition. Since having invested 25 lakhs, the entire amount of 21.19 has been claimed as an exemption under 54 EC. So I need to invest 21.19. I've invested 25. Therefore, I got the exemption of 20.1, which is taken. The case was taken up for a scrutiny but AO determines the capital gains as 49.47 lakhs based on the stamp duty valuation, and therefore passes the assessment order and charge 24.47, which is nothing but, though you have claimed 21.19, but since you have put 25 lakhs in 54 EC bonds, the entire 25 lakhs was given. So the balance amount was taken as a capital gains. So what the SSC was saying, since my entire sale consideration of 25 lakhs was invested in the specified bond, I must get the full exemption from capital gains irrespective of the computation of deemed consideration under 50C. The problem here is that if that view is accepted, so effect is for an investment of 25 lakhs in 54 EC bonds, your exemption would have been 49.47. Right? So therefore, that's one dilemma of the department. So here exemption of 54 are not weighted exemptions, right? You can claim only exemption up to the maximum what you invested. But here, the effect of your claim is that by putting 25 lakhs, you are saying that your exemption is 49.47 or close to 50 lakhs, will almost double of what you have invested. So again, just to, before we go to the relevant section, 54 EC is almost similar to that of 54F, except for the minor modifications. So where the capital gains are assessed from the transfer of long-term capital asset, and the SSC as any time, of course, this has been now changed to land or building from an assessment in 1920. Within a period of 6 months or the date of such transfer, invested the whole or any part of capital gains in the long-term capital. So what is important there is the whole or part of the capital gains in the long-term specified asset, the capital gains shall be dealt with under if the cost of the long-term specified asset not less than the capital gains. So let us see what is the argument of the SSC here. So if you invested the whole or any part of capital gains in the long-term capital asset, the capital gains shall be dealt with if the cost of the long-term specified asset is not less than the capital gains arising from the transfer of original asset. The whole of such capital gains shall not be charged under section 45. What is the SSC saying? So you might have computed the capital gains as per section 50C as 49.47. But for the purposes of 54 EC, for the purpose of 54 EC, what is the capital gains here? Invested the whole or any where the capital gains arises. So the capital gains, if I've invested the whole capital gains, then the entire capital gains shall not be charged under section 45. That means I'm just keeping it out of the charging section itself. Now, what the SSC says, the capital gains here for the purpose of 54 EC should be as per actual consideration, and you should not impute 50C value into the capital gains in 54 EC. In support of this particular point, if you also read 50C, which is there in the same slide, where the consideration received or accruing as a result of the transfer by an SSC of a capital asset, being a land or building or both, is less than the value adopted or assessed by any authority of a state government, hereinafter referred to the Stamp Valuation Authority, for the purpose of payment of stamp duty in respect of such transfer, the value so adopted or assessed. So I've once again shown it in bold, which I promised at the beginning of the discussion. What is resulting in the controversy? Let's take that portions highlighted and discuss. The value so adopted or assessed for the purpose of section 48 be deemed to be the full value of consideration received or accruing as a result of the transfer. So for the purposes of 48, 48 is nothing but it's a computation section. For the purpose of computation of capital gains, be deemed to be the full value of consideration. So there is a fiction created where the stamp value will be replacing the actual consideration for the purposes of what? Section 40. But is it going to be for the purpose of 54 EC? And 54 EC, if you read, the capital gains without applying 50C, if it is invested, then it is keeping the capital gains outside the purview of charging section itself. 45 the close பண்ணிடும். Therefore, the SSC's contention here, though you computed the capital gains is 49.47, for the purposes of 54EC, the capital gains is only 21.19 because 50C does not talk about notwithstanding anything contained anywhere in the Act. It's not there at all. It's not overriding the entire law. It only talks about for the purpose of computation. So for 54EC, I will retain the amount as 21.19. That 21.19 has already been invested, and therefore the entire capital gain shall be excluded from the charging section. But however, if you try to tabulate and work out the number, the effect of this argument is 49.47 is my capital gains less exemption 49.47. AO is now just scratching his head. You have put 25 lakhs and want to claim 49.47. This is not a weighted exemption section. That's where the problem is. Apart from this, SSC made some interesting arguments that when I have only 25 lakhs in my hand, because that 49.47 is a fiction. Actual amount I have is only 25 lakhs. When I have realized only 25 lakhs, you can't expect me to put 49.47. So you are asking me to perform what impossible to perform. So it's impossibility of performance. So therefore, if I have 25 lakhs, I can't invest 49.47. Further, the 50C only talks about for the purpose of computation of section, it will be deemed provision. So deeming provisions must be strictly construed and should be applied only for the section mentioned therein. So you have to limit the purpose of the deeming provision to the same which is enacted, which is only for the purpose of computation. The relevant provisions require harmonious construction because if I have 25 lakhs in my hand, you don't expect me to put 50 lakhs. So the revenues contention was very interesting. The interpretation advanced by the SSC would effectively render the provisions of 50C as redundant. It's a fair point. Because let's assume instead of 49.97, my stamp valuation is even more, my capital gains becomes 100 lakhs. And still you will claim the entire 100 lakhs of exempt because whatever amount you have, you already put in the REC bonds. So that means whatever be my 50C computation of capital gains, you effectively will come back and say nothing is taxable. That means the whole purpose of enacting 50C becomes redundant. So therefore, if you cannot interpret the law in such a manner where the law becomes impossibility of being actually given its intent. The exemption provision should be strictly construed. The SSC can claim exemption only to the extent of investment made in the specific but not beyond. That's a very fair point because you can't say that I have 25 lakhs, I will claim 49.47 as my exemption. But the way in which the department is construing, they are working out the capital gains and finding out, but without raising the fact 54EC does not even want it to work out. It says it will be kept outside the purview of the charging section. That's what I think they missed it out. But however, that's a very interesting decision by the Bombay Court. The deeming fiction under Section 50C of the Act must be given its full effect, and the court should not allow to boggle out the mind while giving effect to such fiction. So that means what the Bombay Court says, 50C should also be considered for the purpose of 54 or 54F or 54EC. Though the court acknowledged that the deeming fiction should be limited to the purposes created, but when we do that, it makes 50C itself redundant. This is an automatic fallout. We do agree with you, but if we implement that deeming fiction principle in this problem, then 50C is gone. Therefore, another principle is gone. The court should always endeavor to ensure that the section doesn't become redundant. So that actually has an effect of 50C becoming redundant. So therefore, what the court said, we do agree with your view, but if we implement what you say, that makes 50C redundant, which conflicts with another principle. Any law legislated by the parliament should be given its true life. You cannot make a section die. So therefore, they said for the purpose of 54EC also, you should work out on the basis of substituted deemed sale consideration and not on the basis of actual consideration. Any other interpretation canvassed by the SSC would render the provisions of 50C redundant. So therefore, we are definitely in support of what you say, but when we accept what you say, that results in more problem to the legislation than otherwise. Therefore, with sympathetic, operation success, patient dead. We agree with your argument, but we will not follow your argument. That's a very interesting point the Bombay is making. Just give me another 5-10 minutes because can just middle of the just another 5 minutes maximum. So we'll just. Then came a very interesting case before the Karnataka High Court, Gauli Mahadevappa. Here the SSC sold the property of 20 lakhs, reinvested 24 lakhs in the residential house. The balance 4 lakhs was out of agriculture income. AO assessed the capital gains by adopting stamp valuation 36 lakhs, but after considering investment of 20 lakhs for exemption 54 of capital gains are written. This is a very interesting view by the AO. So what it says, I will take for the purposes of computation of capital gains and for 54F the stamp valuation. But for the purposes of 54F, I'll take only 20 lakhs because you have only 20 lakhs of sale consideration. You could not have invested 24. That means any investment which you make beyond 20 should have come from some other source. It should not be from sale of property. Therefore, I'll take the numerator as 20, denominator as 36 into capital gains. So this is a very interesting proposition. They will take 50C for the purposes of 54F, but the numerator for the purpose of will be taken only up to the actual consideration. The Karnataka High Court, without getting into the merits of whether 50C should be incorporated into 54F or not, they did not go into the issue at all. What they said was, you have taken denominator as 36, but you should have the numerator as 24. You cannot have a situation where you want to take the denominator as 36 and then say the SSC should only put actual consideration. The SSC should be allowed to invest beyond 20 lakhs to make your capital gain zero by investing from some other source. So, therefore, what they were trying to come back and say, they did not into 54F, should it be substituted by actual consideration? All those points not considered. You are taken denominator 36, though the SSC has got actuals of 2020. Balance 16, he can take a loan, he can take his savings, he can take out of agriculture income, then put it. So what you must understand, Karnataka could never ever discussed should 54F and 50C, how deal with that? That was never discussed at all. So, but however, that was discussed in Rajkumar Parshar, so where this case analyzed that Karnataka court and also came to the conclusion that you should take only actual consideration. That's a controversy. Is what I think. I'll stop because I think the chairman is staring at me, and I'm sure that, sir, you are overshooting, and I know pretty well that in capital gains you will not stop. So I have to stop, forced to stop. Yes, sir, 2 minutes deep. So therefore, here in the Rajkumar Parashar case, they discussed about this in length, and they also concluded that you should only take the denominator as a numerator as the amount of actual investment and denominator as the actual consideration alone. So that means the deeming provisions of 50C should not be incorporated into 54 or 54F or 54EC. Now, this puts into another new dimension to us. If this judgment is followed, most of you know that if my capital gains does not exceed 2 crores, then I can invest in 2 houses. So after 50C, it exceeds 2 crores. If I don't take 50C, it's below 2 crores. In those circumstances, if you follow a Rajkumar Parashar case, you can invest in 2 houses also. So therefore, if you follow the Bombay Court judgment, you have a small problem. You cannot do that because you have to incorporate a 50C into 54 and 54EC also. But if you follow this judgment, you don't have to, for the purpose of exemptions, take the deemed consideration of 50C. So a long discussion there. I will share those things. So that's why given. So which are all in favor, which are all against. A lot of judgments in favor of it, a lot of judgments against. So in the context after the introduction of 56, 210 and 14.4, this has taken another dimension. That also I put in the slide. So maybe after sharing the slide, if you have any questions, I'll definitely will take it to offhand. So before DC switches off me, so I just thank you, G. Thank you, but thanks for the wonderful time. So I'm sorry for the small breakout for a minute. In fact, the screen went blank. And nothing to do with the internet. So, but still, I don't know why it's even
Yeah.
the screen became part after the discussion, I believe. So,
Suresh
thank
sir,
you.
I will now request you to switch on the video actually for a change.
Yeah. So, thank you. Thanks for the opportunity, and thanks all of you for a patient hearing. So, over to Chairmanji.
Yes, sir. Sir, I will take over the presenter rights and put the questions on the screen, sir. Suresh sir, if possible, you can switch on your video now.
No, very seconds.
Yes, sir. Sir, you want me to read or you will read, Suresh sir?
Yeah, I'll read. So, in my view, in the first question, 50C will be attracted. So, can we curb all the capital gains arising on sale of foreign equity shares and different states during the previous year and claim exemption to 54F? Not only that, you can club all the long-term capital gains. In fact, my suggestion is like you can also choose this way. For example, if you take the case of capital gains, the way interesting question from Pratyush. What will happen in this particular case? Suppose if you're going to have a say bonus shares, more easy to explain. So the formula is amount invested by net consideration into capital gains. So the impact of this is if your capital gains
Suresh sir, I think you can switch off your video, sir. Bandwidth issues are there.
you get only 50% exemption.
Suresh sir, we lost your audio. You can switch off your video again and answer it again, sir, please. Sir, we lost your audio, so you can switch off your video. You can answer the question again, sir, please.
Sorry, sir.
You can answer the question again, sir. We lost your audio. Suresh sir? Sir, am I audible? Sir, am I audible to you?
Hello.
Sir, am I audible?
My working case, sir.
Okay, sir, you can answer the question again, sir. Second question.
So in the second question, not only you can claim, what I would suggest is that it is better you work out the capital gains separately and use the capital gains in order. Say, for example, if bonus shares is 100%, if I use my bonus shares first, I will get full exemption. Therefore, you can even work out the proportionate capital gains and distribute the cost of the residential house in a manner in which you can even make it as more beneficial. I would suggest not only you club all the capital gains, all of them will be eligible, but you can choose whichever has got a higher amount of capital gains proportion. You can maximize the exemption. In fact, we have done in one particular case where we found the benefit is pretty huge if you're going to work out shares wise instead of consolidating. To just give a simple example, I have 100 rupees of sale of original shares, 100 rupees of bonus shares. The index cost of original is 50, bonus is 0. If I consolidate and work the exemption, the consolidated exemption will be lesser when you try to take the case of exemption for bonus shares separately and original shares separately, because In bonus shares, you have 100% capital gains. The exemption will be more. And in the case of original shares is only 50%, therefore the exemption will be lesser. So don't average it out. So just do some, use the Excel to the optimum extent. So whereby you can even distribute the exemption based on whichever capital gains proportion is more. That's on the second one. Date of transfer for computing the 2 years since the period of investing the residential loss. It's typically you are to it's the date of possession or the date of registration of sale deed, whichever is earlier can be taken as a more easier way of understanding for all the people. It's something which requires a separate debate by itself. If the assessee sold land and building in June 2020, prior to that already had another flat purchased in May 2019, the answer says he will be eligible for claiming relief under 54. I don't find any issue there because the building and land will be taken. That is what you're going to transfer. So, can the sale process? Can the sale be utilized for the purpose of making payment towards an ancestral residential loss? Yes, in fact, there is a Supreme Court decision is also there. Where the assessee purchased the property from his 4 brothers, the ancestral property, for the purpose of 54. Supreme Court has held that exemption will be available. The word acquire or purchase in section 54 should be given the widest import. So therefore, definitely it will be eligible for exemption. That's Umesh's question part of it. 54 EC can be done prior to the date of sale from own funds. You should make a case for that you have received the advance money from the sale of your existing asset and that you have used, because these bonds sometimes are not going to be in existence. Therefore, you have to make a case for it to claim that exemption to 54 AC. It's not a blanket one, but definitely you can do it. Purchase of land along with building, and building was demolished in due course of time, land is sold. What will be the cost of acquisition? Of course, you can take the cost of acquisition as your earlier cost also, plus whatever amount you're going to use for construction. So assessee paid the entire capital gains account to builder before 3 years period construction, builder delay the project. Plenty of judgments which are given in the slide itself, that's the case number 9. So you can rely upon many judgments are quoted there for the exception. So Narendra's question answered in that way. So
Yes, sir. Now you can switch on your video, sir. Suresh, sir, there is one question from CA KG Warrior. Sir, shall I ask the question? Suresh, sir, am I audible?
audible, sir.
Yes, sir. There is one question from CA KG Warrior. Without purchasing or constructing, part of capital gains is invested in capital gains account scheme. Can the assessee claim that amount for deduction under section 54?
Deposit
I'll flash it on the screen, sir, then. Better. Give me a minute, sir. Give me a minute. Sir, can you see the question? Question number 8.
He can claim exemption as soon as he deposits, but if he eventually doesn't construct, it will become taxable after 3 years. So exemption can be claimed, not an issue. But has to be utilized within 3 years. Otherwise, after the expiry of 3 years, it will become taxable.
Okay, sir. Question number 7. One of the member wants a repeat of the answer.
So as I said, this this will be eligible for exemption because of the fact that a lot of judgments have come, which I've shared in the PowerPoint slide also. In fact, that is my case state number 9. So there are plenty of judgments support the eligibility of exemption. It's there. So
okay, so
I can
we'll
quote
sharing the presentation in due course. Sir, a person received an amount from an inherited property land. Is it taxable under capital gains? If these proceeds are invested to buy a residential house, will he get exemption?
Chairman, it may be better if you put it on screen, I think, because the
I'm
fact
doing that again. I'm doing that. I think there is a small relay issue actually.
yeah.
Suresh sir, question number 9 for you, like ABC.
So person received amount from inherited property land, it's a taxable under capital gains. So I think to rephrase the question, I hope that on the sale of inherited property, which it gets, that's fine. If it's going to be more like a gift, but if he is also getting an inherited asset, it will become taxable because of 491. So in fact, that is the controversy number 8, where how to index the cost of acquisition. Should it be based on previous owner or SSC? A lot of issues are there. Unfortunately, we could not do that. The answer is yes, it's taxable under capital gains. And if it is invested in residential house, you are eligible for exemption also, not an issue. It's taxable and eligible for exemption also.
Yes,
Controversy number 8 will answer this question.
Okay. We'll be getting the presentations from the speaker and sharing it in a day or two. You can also go to SIRC website under the past programs list. The view link as well as the materials link will be shared. So thank you so much for all your presence for the program. Abhishek, if you are there, I will request you to propose a vote of thanks.
Definitely, and it's always a pleasure to propose the vote of thanks when T.G. Suresh sir is the speaker. Thank you so much, T.G. Suresh sir. Such a lovely presentation. And of course, I think all the members can say, whenever you speak, we expect no less, because we always go back home enriched and empowered with more knowledge and more interesting decisions, I must say. Because your unique way of presentation always is excellent. And today was once again another century. Thank you so much, T.G. Suresh sir. I also want to thank our resourceful treasurer, CA Geeta AB, who gave a very lovely opening address and always is supportive of our programs. And I would be remiss not to thank our dynamic chairman, CA Dungarchand Jain, who's leading us from the front and doing such a wonderful job. In fact, we are busy now coordinating the regional conference, as he rightly said, in his hometown. So he is once again leading. I'm sure it is going to be a very grand event. It's the first ever virtual regional conference that we are doing under his leadership. So I request all members who are watching, please do support and please do share the news with all your members, friends to join and participate. Thank you all. I'd like to thank you as well for engaging us and keeping the speaker entertained. Please do share the feedback and please do give us whatever suggestions that you have. We'd love to improve our programs. So thank you so much once and all. Stay home, stay safe. Thank you.
Yeah. Geeta ma'am, any other words you want to share? Geeta madam? Geeta madam, anything is there from your end? Okay, so thank you, delegates. Thank you, all of you. We'll meet for the next any other program of the SIRC. Thank you, all of you. Thank you specifically, T.G. Suresh sir, for a wonderful, wonderful deliberation, actually. Thank you, sir.
Thank you.